Welcome back. I'm here today with Guy Lampard. Guy has a long history in the investment world. He was formerly a partner with Montgomery Securities, and then they merged into what is known as currently Bank of America Securities. And then he's also helped us start up another investment money management firm here in the Bay Area. Guy, welcome to today's show.
Alan, glad to be here. Thank you for having me.
So, Guy, walk me through your background, how you got to where you are today.
Depends on how far back you want to go. I started in the investment business when I was 28 years old, and really had an interest in finance. Was really motivated by the institutional side of the investment world. It seemed very fast-paced and action-oriented, and was fortunate enough to have joined, as you mentioned, Montgomery Securities, and was there for 15 years. One of the really exciting times in the investment world, certainly on the institutional side, with so many companies in that 1985 to 2000 timeframe, emerging growth companies, whether they be technology or biotechnology companies that we brought public. So it was a fun and exciting time.
Now, little trivia here. I guess you immigrated here while you were still in high school.
That's correct.
And what perspective did you bring coming into the U.S. That helped you succeed in your career?
Well, you're kind to say I've succeeded. I think that, I was born in the Far East, and we lived, my family, my three siblings and I lived in the Far East with my parents. And I didn't have much control, obviously, as I was growing up in terms of where we were living. But my father was British, and my mother is Tatar, kind of Turkish. So different ethnic backgrounds. And I do remember very vividly growing up in those years, meeting a lot of different people, whether it was cultural or religious, ethnic, and I think feeling comfortable and being around as a young person around people that are different from you really is a great training ground when you get into business, so that you're not surprised by anything that comes up in a discussion or how people comport themselves. And I think the biggest life lesson for me was just exposure to a lot of people that were different than I. And I think that's helped me greatly.
Having a length of years in the industry from the investment and money management side, how's that changed over the years?
Well, I referenced earlier that back in when I first started at Montgomery, the exciting, really hot place to be was on the institutional side. The idea, especially in San Francisco, of driving into an office in the Transamerica Pyramid, being there at 4:30 or 4:45, the adrenaline of reading newspapers and getting ready for the market opening at 6:30. And a lot of the investment tools that we use today came out of the institutional world. So a lot of the really smart people primarily were on the institutional side. But over the years, we've seen a significant change in that business. The bid-offered spreads have narrowed, the commission levels have changed, institutional equity salespeople are more thought of as folks just shepherding around analysts to different portfolio managers. And so that the whole culture of the trading is now electronic versus more personal with relationships. So I think I've seen a significant shift from the institutional world to what I would call the new institutional, people that are catering to the very wealthy individual client and family. And that seems to now be where the most exciting tools are that are coming out of the investment world.
So the current trends then, as you're moving into the markets, what are they looking for or seeking?
A combination of things. I think we're certainly moving away from this notion of just selling product. I think, and I can speak more towards the ultra high net worth because that's the market and their advisors that we serve at my firm. But the idea is that it's not product driven. It's listening to your client. It's being attentive to their issues and their needs. It's bringing the best options possible in terms of ideas and thoughts that are out there. It's, again, the most important, I think, is building that relationship. The other thing that I've noticed very significantly is that in the institutional world, there's no regard for taxes.
We're running up against the break, and I need to take a quick break here. We'll be right back after his messages. I want to hear more about what we're doing to combat the ever-increasing tax rates in this country.
I love fishing, with my family.
I think it would be easier to use a net.
It was so much fun.
The times when we are together, it makes it all the more worth it.
Having Dad teach them how to cast a fly rod, and
as long as we're doing stuff together, we're having fun.
Some people see a father and a son fishing together, while others see a succession plan. Welcome back. I'm here today with Guy Lampard. Guy was a former partner with Montgomery Securities, later became Bank of America Securities, and then ventured off to, with a few other people, start an investment partner firm, or investment firm that's now $8 billion under management?
We've got just right around $7.5 billion.
$7.5 billion. Yeah. Well, plus or minus $1 billion, right? But it speaks to the success that your firm has had in this industry. And I like to move in. Before the break, we talked about the ultra high net worth individual and tax rates. What is the highest tax rate right now that they're facing?
In California, and this was legislated last year, as you know, both at the state and at the federal level. But people will just start writing their checks next month, the realization of what happened last year. But the highest tax rate for a California resident is 52.6%. So it's a monstrous sticker shock. And what I was mentioning before the break is the fact that most in the institutional world, factors were not put into consideration because they don't pay taxes, and clients do pay taxes.
So the income tax rate is 52.6%.
This is short-term and ordinary income.
Ordinary
it's the highest
income.
marginal tax
How about
rate.
Is Obamacare in that too, or
that includes the 3.8% Medicare increase?
Okay.
So that's an all-in number.
Yeah.
But my point is that people are running around looking for what we call tax alpha. How do I outperform the market?
Yeah.
And the vast majority of people that are taxable should really more focus on the fees that they're being charged and the tax implications of whatever investments they make. Because those are the things that you can control. You're not able to control what the market is going to do. And I think a lot of studies have shown that it's very difficult to pick individual stocks. So the idea of being very efficient in equities and stocks, whether it's an ETF or an index fund or a strategy similar to what we do at my firm, is really important, because then you can lower your fees and mitigate some of the tax impact of these monstrous tax rates.
I imagine with technology increasing as it is and following market trends, that these algorithms are even more complex in terms of following what investment markets are heading towards.
Yeah, we're not a qualitative manager. We're not answering the phone, listening to analysts telling us that IBM should be bought or sold. We're a quantitative firm, so we've got a lot of very smart quantitative folks looking at the efficiency of a portfolio, primarily around taxes. We do other things too. Another trend that I'm seeing, especially in the ultra high net worth, where we have over $1 billion of assets, is in people wanting to socially screen their portfolios. We're agnostic on that. People ask me if I socially screen my portfolio, and I say no. But to the extent that an advisor hears a client saying this is important to them, I think it's important as advisors for us to listen to the client and then figure out ways to make sure that if there's a way to incorporate their values and not negatively impact returns, and make sure to understand that you should do the investment math. You can't, in this day and age, you cannot tell a client, I'll give you subpar returns, but I can socially screen your portfolio. That's not a good solution. But saying that I am listening to you in your social value, whether it's environmental, social, or governance, or carbon-free, which is a big discussion topic of late, but also getting at least market returns on a pre-tax basis, is a very, very important message that I would suggest advisors pay attention to.
I'm visiting here today with Guy Lampard. Guy is an investment advisor with a firm located here in the San Francisco Bay Area with about $7.5 billion of wealth under management. And Guy, we need to take a quick break. And we'll be right back after these messages. And I want to get into what individuals should be looking for in a private wealth advisor. We'll be right back after these messages.
He's the world's most trustworthy man. Tax filing deadlines are scheduled around his vacation calendar. The IRS agent who audited his client apologized.
I don't always advise people on their taxes, but when I do, I save them every penny legally possible.
GROCO CPAs and Advisors.
Come to GROCO and stay wealthy, my friend.
Welcome back. I'm here today with Guy Lampard, and we've been talking about private wealth management. Guy is with the firm with $7.5 billion wealth under management, and I knew you when you started this firm with just a few $100 million. You know, it sounds funny, just a few $100 million, but it speaks to the effect of how successful things have been going for you, the way that you've been been able to grow it in a short period of time. Guy, what should individuals look for in a private wealth advisor?
It's a really good question, and I get that question quite often. I think the most important thing, to be honest with you, is a personal connection. There needs to be a chemistry and a sense of kind of transparency between an advisor and a client, and so there's no one advisor that's perfect for every single client. There's a chemistry component piece to it. But I think some of the important things that are really important, if financial planning and succession and multi-generational issues, make sure that you find an advisor with that sort of skill set on the financial planning, side. I think that if there are issues around taxes, which come up as we mentioned earlier with my firm a lot, I think it's really important that an advisor pay attention to the impact of taxes on returns. I think that's another very important component piece. And I also think that fees are a huge degrader of performance. So you really want to make sure that you're getting good advice, but you're not overpaying for it. So understand the fee structure. Make sure that your advisor is not being compensated by selling you products. It's more consultative on a fee-only basis. I'm not a fan of that term, but because our gardeners are fee-only. But nevertheless, it's important to separate product from advice and make sure that you're on the same side of the table. So those are some of the important things.
When an individual comes to you, typically what level of wealth do you want to, is there a minimum level that you'll require before you'll accept them as a client?
I'm going to make a distinction because we really don't accept clients directly to my firm.
Okay.
We work primarily as through advisors of wealth advisory firms. So we're managing the equity or the stock component piece to the overall asset allocation of a client. In some cases, if the family is significantly large with a family office structure, they come to us directly because their assets are so substantial. But for the most part, we're working through advisors around the country. I think we work with about 120 different advisory firms around the country. In terms of their end client, probably the average net worth of assets that we're managing would be 20 million plus in terms of the end net client. But that can range, obviously.
What's your opinion on Markowitz and his models?
He is an icon and godlike in the investment world, and he's still going strong. One of my colleagues who is head of research, Lisa Goldberg, who also runs the Center for Risk Management at Berkeley, saw him recently. I think there was some issue after the downturn of whether capital asset pricing model, was still functioning. And I think the reality is yes. When I look at the idea of just plain indexing and being very efficient on the tax side, especially with a strategy similar to what we do in separate accounts and with low fees, it is as resonant today as it ever has been.
So it sounds like an individual that you love to work with is a person with a liquidity event coming off, and they have lots of built-in gain that you can work towards to help shelter some of that by tax-efficient portfolios?
Yes, I think the idea is that in very efficient markets, and I'll define efficient markets as the Russell 3000, let's say the broad U.S. equity market, or more recently, we've seen a huge migration for our clients using global benchmarks. So the MSCI All Country World Index as their benchmark. So that one benchmark, you can get the world's global equity on one line item. And the idea there is if you can get that at low fees in a very tax efficient way, then you're way ahead of the game. And then focus your efforts and energy on other asset classes, whether it's hedge funds or private equity or real estate, where it's not as efficient and a great set of skills and advisors and managers can add alpha there. But to think that you're going to pay higher fees on the equity side of the asset allocation and outperform as a market, as a society, I should say, we are the market less the fees we're charged. So if we accept a market return and we accept capitalism and get it tax efficiently at low fees, let's go find our alpha in other parts of our investment worlds.
All right, quickly, we got a book that you just put out. Can you tell us about that?
Sure. It's actually been a few years now, but after my 15 years at Montgomery Securities, I decided to take a sabbatical and was trying to figure out what best to do. And a dear friend of mine had just retired. So this was in 2000, just retired. And so we were imagining what we could do as a major volunteer project together. We started talking to people, and the one thing that I realized was that the baby boomer generation was just starting to retire in 2000. And this is the post World War II, 1946 to 1957, sort of 1960 birth range. And a lot of this generation, my generation, we've been raising families, we've been working hard, we've invested in our businesses to try and be successful, but maybe we hadn't done as much around community service as we could have. And now as we retire, is there a book that I could produce and write that could help folks coming into retirement, giving them ideas on volunteering efforts? So that was the motivation for the book, and enjoyed it immensely and met some wonderful people through that process.
Well, yeah, I think there's nothing better in life than giving that service, giving back to what you've been able to create.
With current laws, we have left our children an enormous financial burden. Even though they may be too young to understand it. At GROCO, we care about you and the ones you love, and the quality of your and their lives. Call us today to see how we can help. 877-CPA-2006.
Helping you along the way.
Advisor into the Bay Area for several years, formerly a partner with Montgomery Securities, and then started up a successful investment advisory firm with around $7.5 billion of wealth under management. During this break, we began talking about social networks, and there's a story about Paul Revere. And Guy, can you share that for the listeners?
Sure. April 1775, when the British came into Boston Harbor and had wanted to go to Concord to get the military arsenal, the Patriots, the New England Patriots, sent out two riders that day, Paul Revere, who we all know, and another fellow by the name of William Dawes. And what I'm told is that they both had and knew as many people as the other did. In fact, actually, Dawes knew more people, but they went in different directions. And Revere went across the river as they were trying to alert the local people about the fact that the British were coming. But we only know about Paul Revere. Nobody knows who William Dawes is. And the reason for that is that Revere was a very interesting person, had a lot of different interests and hobbies. He was a farmer, he was a publisher, he was a writer, he was an editor. And so whenever he notified somebody on his great and famous ride, they would tell their circle of acquaintances and friends. And that network continued to grow. Dawes was much more singular in terms of what he did. So he knew as many people, but they were all pretty much doing the same thing. And so the reality is that as we build out, and this is a great, I think, example of a social network, as we build out social networks, whether it's through the volunteering efforts that we do or other areas where we're stretching ourselves just a little bit to be in communities where maybe we're not the experts, it greatly enhances us, and I think it enhances the community and society at large.
Yeah, I think there's a good story there also with respect to connecting with people throughout your life. It reminds me of a guy who, spent the majority of his life up in Alaska as a hermit, and then he built this cabin and was living off the land very successfully, and then he grew old and finally had to go back into the real world.
Mm-hmm.
How many years of his life were missed not interacting? The story of Paul Revere, the fact that he learned how to connect with people, made him a legend. And I think there's something for us to learn from the experience there.
Well, I bring it up because it so affected me when I heard the story years ago, and it really is a life lesson that I think to kind of enrich our lives, it's great to kind of push ourselves a little bit and to get involved in other worlds, which then help connect ours to a greater community.
So a person looking at getting involved, they come to you, Guy, I just heard what you said, but where do I start? What advice would you give them?
There are a number of organizations, especially with technology now. If it's involved in volunteering, the ability to go into websites and find volunteering opportunities around. And it doesn't necessarily, it doesn't mean that you don't have to have a kind of a selfish component to it. I remember when my wife and I first moved to Mill Valley, one of the things that I did was to volunteer to coach Little League, which I did for 5 years. For me, selfishly, it was a way for me to get to know people in the community, in a new community I didn't know. Or I've heard stories, for example, of somebody wanting to build an addition to their home. So what did? They volunteered at Habitat for Humanity because in addition to getting skills of how to build something that they like to do themselves, they connected with their community. So it's an opportunity to be helpful and selfish, but also help your community as well.
So, Guy, if a person wants to contact you or access your fund, how would they go about doing that?
Boy, so we all of our portfolios are separately managed, so we don't have a fund per se. They're individually managed. I think probably the best if they want to contact me directly, as I mentioned, we primarily don't work directly with folks, but if I could be helpful in any way, glampard@aperiogroup.com is my email address, and I'll be delighted to respond to any inquiry that I get.
Very good. We've been visiting here today with Guy Lampard of Aperio Group, and thanks for being on today's show.
It's been my pleasure. Thank you, Alan.